Right now, while you hold a position, a stock, a fund, a market thesis, your brain is filtering information about it. Not passively. Actively. The mechanism is called confirmation bias. And it operates before your analysis begins. Before you open a report. Before you check a single data point. Research in cognitive neuroscience has established something precise and uncomfortable: you do not evaluate evidence and then form a belief. You form a belief, and your brain selects the evidence to support it. Every investing mistake this produces follows from that single fact. And the research suggests it is costing investors money, systematically, across every market condition. This channel examines the neuroscience of financial decision-making, the cognitive architecture that shapes investment outcomes regardless of strategy or stated intelligence. Today's subject is confirmation bias. Not as a rhetorical device. As a documented biological process with measurable consequences for how investors hold, exit, and re-enter positions. Camera change, we will cover 3 areas precisely. First, the neurological mechanism. What is actually happening in your brain when you evaluate information about a position you already believe in? Second, what the empirical research has found, with specific attention to the work of Philip Tetlock, Daniel Kahneman, and behavioral economists including Terence Odean. Where studies are frequently misrepresented in popular media, that will be noted. Third, a 4-part framework, grounded in that same evidence base, for restructuring your decision process in a way that confirmation bias cannot as easily subvert. Pacing, measured. 1 idea per sentence. Let the weight land. 1 preliminary note. The popular literature on confirmation bias is full of overclaims, studies cited as showing one thing that actually shows something adjacent or weaker. Where that is the case today, it will be flagged explicitly. Precision matters here. A framework built on misread science is itself a form of motivated reasoning, which would rather undermine the point. By the end of this video, you will have an accurate model of this mechanism and a practical protocol for countering it. Let us begin with the mechanism. Your brain processes an enormous volume of incoming information at every moment: sensory data, memory associations, environmental signals, far more than conscious awareness can handle. The filtering that occurs is not random. It is structured around what your brain has already determined is likely to be true. This is efficient. It allows rapid pattern recognition and fast decision-making. It is also the origin of confirmation bias. B-roll CUE, MRI brain scan with highlighted activity regions. Research in cognitive neuroscience suggests that when you encounter information consistent with an existing belief, the brain's reward circuitry shows measurable activation, a response consistent with what researchers associate with prediction satisfaction. Being confirmed produces a neurological signal that resembles, in miniature, reward. Disconfirming information does not produce the same signal. Evidence in this area indicates it requires meaningfully more cognitive effort to process and integrate. This asymmetry is not a metaphor. It appears to have a neurological basis. Daniel Kahneman's framework, developed across decades of research and synthesized in his work on cognitive biases, describes 2 distinct modes of thinking. System 1, fast, automatic, associative, and pattern-seeking. System 2, slow, deliberate, effortful, and analytical. Confirmation bias largely operates through System 1. Your intuitive sense that a position is sound, the gut conviction you formed when you first built the thesis, is a System 1 product. And System 1 does not pause to weigh disconfirming evidence. It defends the pattern it has already constructed. Unexpected stat: Kahneman's framework holds that System 1 operates continuously and generates impressions and intuitions that System 2 often endorses without scrutiny, not because System 2 is lazy, but because System 1's outputs usually feel sufficiently credible. Now apply this directly to portfolio behavior. You buy shares in a company. Your thesis is formed. From that moment, you are not a neutral observer of information about that company. You are a motivated reasoner. A positive earnings report arrives, it registers as confirmation. An analyst issues a downgrade, System 1 surfaces a reason to discount it. Warning signs in the footnotes of a 10K, they require deliberate, System 2 attention to detect, and System 1 is not providing that attention automatically. The bias is not a choice. It is the default operating state of a brain optimized for cognitive efficiency over analytical accuracy. Understanding that distinction is the foundation of everything that follows. If this kind of research-grounded analysis is what you are looking for, subscribe. This channel publishes one video per week, no motivational filler, no guru framing, only the neuroscience behind financial decisions, examined with precision. We now turn to the empirical record, and this is precisely where popular accounts of confirmation bias in investing lose credibility. Studies are frequently cited as proving things they do not prove. We will read this literature carefully. Camera change. Werner de Bondt and Richard Thaler published influential research in 1985 examining patterns in investor behavior at scale. They found evidence that investors systematically overreact to extreme events. Stocks that had experienced the most dramatic prior price changes tended to reverse direction in subsequent years. The research indicates that investors appear to place excessive weight on recent, salient, confirming information and insufficient weight on longer-term base rates. This pattern is consistent with confirmation bias operating across a market. De Bondt and Thaler were examining overreaction broadly. Confirmation bias was part of the framework they were working within, not an isolated variable they tested, but the behavioral signature their data showed is precisely what confirmation bias predicts. B-roll CUE, stock chart showing dramatic reversal pattern. Philip Tetlock's work is perhaps the most directly relevant in the professional context. His research examined expert forecasters, credentialed specialists making predictions in their field of expertise over extended periods. Tetlock found that these professionals are not immune to cognitive biases, including confirmation bias. Expert forecasters showed a strong tendency to seek out information consistent with their existing predictions while discounting evidence that complicated them. Note what this research demonstrates: it was not a study of retail investors, behavioral amateurs, or people operating outside their domain. These were professionals whose stated function was accurate prediction. The bias persisted regardless. Graphic. Tetlock's finding: expertise does not confer immunity. Terence Odean's research examined actual brokerage trading records and found that overconfidence, a bias closely related to confirmation bias, and one that frequently co-occurs with it, can lead investors to trade excessively and achieve demonstrably lower returns. Research in this area suggests these biases cluster. Investors who exhibit strong overconfidence tend to exhibit confirmation bias patterns as well. Barber and Terence Odean extended this work and found evidence that overconfidence produces measurably poorer investment performance across market conditions and investor types. The pattern holds across the behavioral finance literature. Camera change. Finally, consider the structural amplifier that modern investors face and earlier researchers could not have anticipated. Research by Bondt and colleagues found evidence that exposure to social media and online forums increases the likelihood that investors encounter information consistent with their existing views. The recommendation architecture of these platforms is not a neutral delivery mechanism. It is, by design, a system that shows you more of what you have already engaged with. For an investor with a strong thesis, this creates a closed information loop, one that research suggests actively reinforces existing positions rather than subjecting them to challenge. The conventional response to confirmation bias in investing circles is well-intentioned and incomplete. It runs roughly as follows: seek out the opposing view. Find the bear case for your bull thesis. Read the short seller reports. Actively look for people who disagree with you. Sound effect, subtle low transition tone. This advice is not wrong. It is simply insufficient, and there is a specific neurological reason for that. Seeking disconfirming information is a behavioral intervention. It changes what information you are exposed to. But confirmation bias is a neurological process that determines how information is weighted once it arrives. You can deliberately sit down and read the strongest available bearish analysis on your highest conviction holding. Your System 1 will still process it differently than it processes bullish analysis. Research in cognitive science suggests that motivated reasoners, people who have a material stake in a conclusion being true, do not simply ignore contradictory evidence. They critique it more aggressively. They surface methodological objections to studies that challenge their beliefs that they do not surface for studies that support them. The standard of evidence applied is not uniform. It shifts based on which side of the argument the evidence falls on. This pattern is sometimes described in the cognitive literature as my-side bias, and it is precisely what makes simple exposure to opposing views an incomplete remedy. More information, without a structured protocol for evaluating it equitably, may not help at all. In some cases, it provides new material for post hoc rationalization, which feels like due diligence but is not. Everything covered to this point describes the problem with precision. The mechanism, the research record, and the reason the standard remedy falls short. What follows is the part of this video with the most direct practical consequence. Because the same body of research that characterizes the problem also points toward a framework for countering it. Not a mindset. A structured process, one that changes the conditions under which your decisions are made before the bias has an opportunity to operate. Research on decision-making supports a consistent finding: structural interventions, changes to how decisions are made, are more effective at reducing cognitive bias than awareness alone. Knowing about confirmation bias does not appear to make people substantially less susceptible to it. What changes outcomes is process architecture, decisions and constraints established before the emotional charge of a live position can distort evaluation. Graphic, 4-step protocol overview. Step 1 is the premortem. Before entering any position, you write a structured account of how it fails. Not how it might fail in theory, how it does fail. You assume the position has already produced a significant loss 18 months from now. Your task is to explain what happened. This technique was developed by psychologist Gary Klein and later described by Kahneman as one of the most effective available tools against overconfidence and motivated reasoning in high-stakes decisions. The premortem works because it reframes the cognitive task at the System 1 level. Standard due diligence asks, "Why will this work?" That question activates confirmation seeking. The premortem asks, "Assume it failed, trace the path." That question activates a different cognitive mode. Research in this area suggests that this reframing surfaces risks that standard analysis systematically misses, because those risks were previously filtered by the motivated reasoning System 1 was already engaged in. B-roll CUE, person writing deliberately in a notebook before a terminal with market data. Step 2 is asymmetric sequencing. Before reviewing the bullish case for any position, you read the best available bearish case first. This is not a balance exercise. It is an anchoring intervention. The brain anchors to information it encounters early in a sequence, and subsequent information is evaluated relative to that anchor. By anchoring to the counterargument first, you require the bullish thesis to work against an established prior rather than simply accumulate on an empty slate. The sequencing of information consumption is not neutral, it shapes which claims you accept and which you interrogate. Inverting the standard order of research is a low-cost, high-leverage structural change. Camera change. Step 3 is the adversarial collaborator. This is drawn directly from Kahneman's own practice. You identify a person, a structured checklist, or a formal process whose explicit function is to attack your investment thesis with the strongest available evidence against it. This is structurally distinct from seeking out opposing views casually, because the adversarial collaborator has a formal role and a clear mandate: find the most credible case against this position. This externalizes the cognitive work that confirmation bias prevents your own System 1 from performing. An adversarial collaborator does not need to be persuaded of your thesis first, which means they approach the evidence without motivated reasoning already installed. Step 4 is pre-committed exit conditions. Before a position is entered, you document the specific, measurable conditions under which you will exit, not vague principles, but concrete triggers. If revenue growth falls below a specified figure. If a named catalyst fails to materialize within a defined window. If a key operational metric reverses for 2 consecutive reporting periods. This step matters because confirmation bias operates with particular intensity on exit decisions. Research on overconfidence and trading behavior, including Odean's work, indicates that investors systematically hold losing positions longer than they hold equivalent winning positions, a pattern sometimes described as the disposition effect. The mechanism driving it is precisely the motivated reasoning we have traced throughout this video. Each negative data point gets critiqued, each positive signal is accepted at face value. By pre-committing to exit conditions before a position is live, you remove the conditions under which post hoc rationalization operates. The decision is already made. The bias arrives to find the structure in place. Pacing, pause between steps. These are disciplines, not list items. Kahneman's broader framework is instructive here. The goal is not to eliminate System 1 thinking. System 1 is fast, often accurate, and in many contexts genuinely useful. The goal is to create structural conditions in which System 2 can meaningfully intervene before high-stakes financial decisions are finalized. These 4 steps are that structure. Confirmation bias is not a character flaw. It is the default operating mode of a brain that evolved for speed and pattern recognition, not for the dispassionate evaluation of conflicting financial evidence. The research, from Tetlock's forecasting studies to Kahneman's framework to the behavioral finance literature of Bondt, Thaler, Barber, and Odean, points in the same direction consistently. Awareness of a bias is a necessary condition for addressing it. It is not a sufficient one. What changes outcomes is structure. Process architecture. Decisions and constraints built in before the emotional weight of a live position compromises evaluation. Camera change, the 4-part protocol in this video, pre-mortem, asymmetric sequencing, adversarial collaboration, and pre-committed exit conditions, does not guarantee better investment outcomes. Markets are uncertain, and that uncertainty is irreducible. What the evidence supports is narrower and more honest than a guarantee. Investors who build deliberate structure into their decision-making process make fewer systematic errors of the specific type that confirmation bias reliably produces. That is a meaningful reduction in one category of avoidable loss. Graphic, end screen overlay. If this kind of evidence-grounded analysis of financial cognition is what you are looking for, subscribe. New research-based videos publish each week. And the next video, on loss aversion, and why research suggests your brain weights potential losses more heavily than equivalent potential gains, is linked on screen now. Loss aversion and confirmation bias interact in ways that compound their individual effects. It is worth understanding both.